Hello friends, how you doing out there? This is Vijay Bhambwani, and in this video, I'm going to talk to you about the various financial crises that have hit the markets in the last couple of decades that I have been in the markets. As I have told you in my earlier videos, I've been trading since 1986, and I've done 35 years of trading in this market, 28 of which are as a founder, promoter and CEO of a limited company that trades for a living. Now, what are the crises that have occurred in the market in the past? What are the key takeaways? How do they start? How do they end? What is the feel during these crises? And what are the lessons that you can learn from them? Now, I would divide these crises in two separate categories. Both are, of course, man-made. One is the crisis caused by political/terror factors. So, for example, after I started trading in 1986, I saw Saddam Hussein invade Kuwait. I saw the erstwhile Prime Minister Rajiv Gandhi assassinated in Sri Perumbudur. We saw the bomb blasts at the Bombay Stock Exchange and other locations across Mumbai. And what is typical about these crises which are triggered by terror attacks, wars, or other conflicts is that the markets did not really flinch much, because these were not financial crises, directly financial crises. On the other hand, I would have at least 4 major crises that were completely triggered by financial factors, and to the extent that you could call them financial crises and even scams to a certain degree. And the markets took these rather seriously. And what is typical about the political/terror crisis was that the markets simply shrugged these away. Now, I remember the bomb blast took place on a Friday, and the government of Maharashtra went into overdrive. They saw to it that the exchange opened on Monday. Trading took place not in the regular trading ring, and the trading, of course, was not for those 2 hours that it was usually conducted at. It was a truncated trading session. L&T and Mumbai Telephones came together and put up a makeshift switchboard exchange so that brokers could communicate with their offices on hotlines, etc. The market actually shot up. This was the government's way of saying, hey, we are not really scared of terror attacks. Same with the bomb blast that took place in 2003, the bomb blast that took place in the Mumbai locals, the Ghatkopar bomb blast which took place in the BEST buses, etc. So the markets don't really take these crises very seriously. But let's take a look at the 4 major crises that I've gone through, experienced them in the market since the time I came in the market. The first one was the Harshad Mehta scam. Now, Harshad Mehta, as you have all seen his tele-series, and those of you who were not in the market at that time, especially the millennial traders of today, he was the Pied Piper of Mumbai. He would basically give media interviews, show people off his fast cars and limousines and his swanky offices in South Mumbai, and throw around names of stocks that he was interested in buying. And guess what? The very next day, those stocks shot up. What really was happening was that Harshad Mehta was helping himself to funds that were not his. Using the Securities General Ledger, using the loophole in the government bond markets, he was helping himself. Of course, there was a lot of crookedness going on. There was even instances where people, I'm not taking any names here, people pledged Unit Scheme 64 certificates after manipulating those certificates. It was actually 100 or 1000 units, I forget which, but it was overwriting ink was used, and it was made to look like 1 million units. Now, these were pledged as collateral, money was raised and stocks were bought. To the extent that many corporates which were not allowed to invest in the stock market by their memorandum and article of association actually invested money in the markets. This was a scam by itself. As usual, by now you've watched this series, it did not end well. What was the feeling in the market in those days? The feeling of the markets was of revelry, was of recklessness, invincibility, a total feel-good factor, and the feeling that the party would never end. And the party, when it ended very, very badly. I have not seen retail euphoria which I saw in 1992 ever again. Then came the LTCM crisis, triggered by the Southeast Asian currency crisis in 1997-1998. Now I'm clubbing these two together, although there would be some people and market historians who would like to treat them as separate. But what really happened was that Asia was receiving money faster than it was asking, and low-cost funds. It was receiving this money from the US and other international monetary agencies in US dollars, the condition being that the principal and the interest would have to be paid in US dollars, which these guys willingly agreed to. And suddenly, the US started ramping up dollar prices. So what happened if the dollar went up 30% against your currency? Your loans became 30% more expensive in terms of paying interest, and your debt became 30% higher in spite of the fact that you did not borrow any new dollars. Now, this is something which drove countries to bankruptcy. If you were to switch on CNBC Asia, CNBC India was not born then. If you were to switch on CNBC Asia, you would have seen horrible scenes of POSCO workers crying when they are coming out of the factory and putting their jewelry, their earrings, their necklaces, their watches and cash into the drums where the management was standing with folded hands, black suits for mourning, and crying themselves and apologizing to all the workers to donate money to the company so POSCO could actually return foreign debt. Now, this is something that you have to live through to be able to see what's happening. Now, in this very, very turmoil-ridden market came a very aggressive hedge fund in the US which was called LTCM, or Long-Term Capital Management. Promoted by 16 hotshots, 14 of whom were ranking and high-ranking MBAs, gold medalists, Wall Street blue-eyed boys having worked in investment banks and merchant banking outfits of repute. 2 of them were Nobel laureates who actually gave you the options premium pricing formula. Wall Street thought this company could do no wrong. Guess what? They started raining money on these guys. Roger Lowenstein, a noted writer, author, has written an excellent book called When Genius Failed. Why? Because all 16 of these guys were undeniably of genius category. And remember, 2 of them were Nobel Prize winners in economics and finance. You trade options based on their theories, right? So, LTCM started taking crazy bets on crazy leverage. Now, this was the first time a hedge fund was betting money bigger than the GDP of many small countries, to the extent that by the time LTCM actually collapsed in 4.5 short years after incorporation, they had basically taken leverage to the extent of 240 times, if not higher. What does leverage mean? You have $1 and you have placed bets worth $240. What really happens? Even a 0.25% of a mark-to-market loss will wipe you out completely off the charts, which is what happened to LTCM. They started bargain buying in a falling market, thinking the market could not fall lower. All right? They bet on the Nikkei, they bet on the Italian currency, they bet on the Mexican peso, they bought Russian bonds. They actually went crazy because the public was throwing so much money at them, they didn't know what to do with it. And hey, so they took very aggressive bets. Guess what happened? By the time LTCM was deemed to be collapsing, the US Federal Reserve came in, and this is what the millennial children in the market today must hear carefully. The US Federal Reserve stepped in, had night-long meetings, closed-door meetings, and forced 14 large investment bankers to lend money to LTCM with the words, "Lend money or else." This was a threat. Lend money or else. Now these guys were forced to give LTCM money because President Bill Clinton had already come under a cloud because of the Monica Lewinsky affair, his sex scandal in the White House, and he didn't want any further problems, and definitely not an economic collapse triggered by a stock market collapse. Remember, LTCM had more than 250 billion in exposure in the markets. And in 1997, $250 billion was big. It's big even today. Big even today. Alright? So, it is these very investment bankers which lend money to LTCM in 1997-98. Most of these went bankrupt in the global financial crisis of 2008 because their balance sheets were so stretched by giving these loans to LTCM which they could not afford to, that when the next crisis came, these bankers simply exploded. Now, one crisis plants the seed for another. That is the lesson of history which the millennial children are not understanding. Alright? So, LTCM, when the party lasted, if you read Roger Lowenstein's book, When Genius Failed, you will be appalled, you will be shocked, and you will basically be dumbstruck. These guys were actually partying even when their markets started tanking because they were sure they would get more money. And guess what? The public was throwing money at them. What was the mood in those days? Absolute recklessness, invincibility, arrogance, and a feel-good factor that the party would last forever and forever. Let's now go to the third crisis, the dot-com bust. Now, this was again a scam by itself. I believe some of the viewers are old enough who are watching this video of mine to have experienced the dot-com crash of the year 2000. It's also called the Y2K crash. Alright. Now, technology companies, software companies, anything to do with computers was flying off the shelf and zooming. To the extent that many stocks in India, including one registrar and transfer agent, changing his name to sound like a software company, saw the stock price multiply. I'm not saying rise, I'm saying multiply. That was the amount of craziness that was happening in the year 2000 and even slightly before. Guess what? Every collapse needs a Pied Piper. The dot-com bubble was fueled by a crooked guy called Henry Blodgett. You have a screenshot of what I want to show to you about Henry Blodgett. He has been barred for life by the Securities and Exchange Commission in the US, and the reason why he was caught, he was working for a very large investment bank. He would go out on television, CNBC and CNN and Fox News, etc., and talk up the prices of dot-coms. I'm sorry. The very next day, after Henry Blodgett came on TV, the very next day, those dot-com stocks would not rise, they would multiply. You know what? He used to write arrogant emails to his fellow colleagues. Look at those dumbass viewers of my television shows. They are actually buying this garbage at the valuations I tell them to. Till one of his colleague, whose conscience bit him, complained to the SEC that what's going on in my company is absolutely wrong. Investors are being misguided and you should take action. An immediate inquiry was put in place and Henry Blodgett is now barred for life. If he writes an article on his blog, he has to mention that he is a debarred entity whose advice should not be taken seriously. Guess what happened? Even during the dot-com bust, and retail participation during the dot-com bust was second only to the Harshad Mehta scam. I have not seen retail participation return to that level ever. I'll come to the reasons why. Here again, invincibility, arrogance, complete recklessness, and a huge feel-good factor. People had found the fountain of money. People had found the fountain of happiness. And therefore, nothing could go wrong. The stock market party would continue. People were borrowing money to invest in shares. And the stocks that I have seen like Himachal Futuristic, Global Telesystems, they are trading at less than 10% of what they were trading 20 years ago. Let's not even count the interest cost of 20 years. There are companies like Pentafor Software or Pentamedia Graphics, etc., which just don't exist. Satyam Computers, gone. So, here again, history has told you that this absolute craziness doesn't really last. Then came the global financial crisis of 2008. I told you the seeds of this crisis were actually sown in the LTCM crisis and Southeast Asian currency crisis of 97-98. Now these investment bankers who had lent so much money to LTCM, and by the way, LTCM 6 months after receiving this bailout money worth billions of dollars was allowed to die a quiet death because people forget. People move on in life and they forget these hard learned lessons. So LTCM quietly died, and the investment bankers who had lent money to LTCM wrote off this amount and took a hole in the balance sheet. It was these very investment bankers, Bear Stearns, Lehman Brothers, Merrill Lynch, etc., which took the fall in 2008. Here again, when the party was going on in 2008, people were arrogant. They thought the party would never ever end, and there was absolute recklessness. Now, why did I say that the participation levels never really returned back? Today, the millennials are rushing to the market out of sheer frustration of not having jobs or not being able to start their businesses or not getting funding to start their new businesses. But still, the scale that I saw in the Harshad Mehta scam and during the dot-com bubble of 2000, every alternate person I met had invested money in the market. To my utter horror, I have seen people enjoying generations of wealth, living in huge swanky houses in South Mumbai, were forced to liquidate their assets to pay for their trading debts and losses, and move either out of Bombay or into the deep suburbs of Mumbai, never to come up in life to their previous living standards. If you actually go back in time and Google search and research, you will find that Indian divorce rates actually jacked up higher after the dot-com bust. Lovey-dovey couples who could not live away from each other actually could not stand each other after the money went out of the window. The divorce rates simply jumped up. And this is a fact of life. So when you lose money, the implications are not just financial. They are also social, they are also personal, and they are also emotional. Which is why you must learn from these crises, because all crises look exactly the same. And the participants also behave exactly the same. The reaction is, oh, this time it's different because X, Y, Z. This time it's different because the Fed is printing money and the money supply will never end. Look around you. Not much has changed. Jesse Livermore, the greatest speculator of all time, says, it's only the means of doing business that changes in the market. People's attitude towards the market will never change. And he said it almost 3/4 of a century ago. Still true words, and nothing has changed. These are lessons of history, my friends. Do keep looking back in the past, because as the old saying goes, those who do not learn from the lessons of history are condemned to relive them. Let's not relive the painful lessons of history. Let's learn from the past. If not by going through the pain yourself, at least hearing somebody else who has gone through it all. Have a very, very safe and profitable time ahead in the markets. Vijay Bhambwani signing off for now. If you liked what you saw, subscribe to my YouTube channel, click like, share my video with like-minded friends in the comment section. Do let me know what you think of this video. Thank you for watching. Take care. Bye-bye.